for more. I appreciate you joining me on what is a very interesting note, Tom. Thanks for being here.
Yeah, great to see you, Scott.
So your head of technical strategy is Mark Newton, and you say that he believes the S&P 500 might be near a peak by the end of this week. This, in turn, likely results in some consolidation, which could retrace 38 to 50% of the move from October before markets can push higher into December. So we're about 9% higher since the beginning of October. Let me ask you first and foremost, do you agree with your chief technical strategist on what he has to say?
Mark Newton's been exceptionally good at making tactical observations at turning points. So I think it warrants us warning clients, and that's why I made it so prominent in our commentary to clients today. I think there are some fundamental factors sort of supporting this. One is there is a macro uncertainty now with regard to Fed chair. And as you know, if there is a change in chairmanship, the markets are going to test that person. So I think it does create poor visibility. And we know COVID cases are rising. And while we don't want clients to be alarmed, it looks like we're going to have something that looks like wave 4 underway. And I think it's reflected in why there's been a rotation into defensives. And I think a defensive-led rally isn't as healthy, especially into the period into Thanksgiving. So I'd agree that I think that we could have a speed bump, and hopefully it's not 5%, but it could be something that warrants warning clients.
But you think we're at what, excuse me, the words that you just used, a turning point, potentially. And hearing you say that is big news to our viewers, for sure, given how bullish you've been. I said you guys have been the most bullish firm on the street. You've been certainly right up there at the top in terms of strategists. You told me the last time that you were here, which was only a couple of weeks ago, 4,800 on the S&P is your year-end target. Wouldn't even surprise you if we could get to 5,000 by the end of the year. This feels like a real turn, Tom.
Scott, it's as you know, it's hard to tell what could happen at a turning point. So I might say that our base case remains whatever happens is a buyable pullback. I think we still exit the year strong because it would be a textbook pullback into a December rally. And that means we could still be 4,800 or 4,850, but it wouldn't be from 4,700 here. It could be from a lower level. So it actually ends up being a very viable dip.
So we may just
and I think
I'm sorry, we may just have to work. Forgive me, Tom. We may just have to work a little bit harder to get to your optimistic target of 4,800.
That's right. And I think the one thing I'm watching in the next couple of weeks is just, relative strength, because, there has been some weakness developing in some sectors. So that's what I'm watching. But for now, I think the market overall is healthy, and it's great to see the NASDAQ rally because, as you know, that really is anchoring a higher S&P as a NASDAQ rally. You
write about tech being, quote unquote, exhausted, or at least feeling exhaustion. Is that what we see now? And the NASDAQ, after having an incredible run, is going to potentially lead the decline lower, at least in that near term?
Yeah, I think, and that's Mark's words. And I think what he's referring to is things like semis, which, did have what looks like a little bit of a parabolic lift. But there's parts of tech that still look strong, like system software. So I think there's enough health in tech that there's no break in trend. But what he's referring to is the idea that you're going to have a pause that refreshes. And as you know, in this kind of market, especially so close to year end, people just treat 2% drawdowns like it's an annihilation. So I think there is a chance for people to overreact, and that's why you'd need to buy that dip.
And let me ask you about the Fed chair question, which you brought up, which I was going to ask you about anyway, and how the market would view that. Brainerd may bring on more regulation. Certainly, that's one of the issues that people are talking about. Clearly, she may be more dovish, which would be a positive viewed by the market, I would assume. But it sounds to me like the mere change of the person in the chair would be risky enough at this particular juncture.
Yeah, I mean, I wouldn't say it's a bull market killer, but I think it's an adverse development. Changing the Fed chair and, so close to the end of the year and 1 year into an expansion, I don't think from a timing perspective, that's great. And that's also, as you know, the bond market especially is going to test a Fed chair. But it also really speaks to the idea that progressives have enough power to actually force a change of the Fed. I mean, this has very little to do with the Fed, and it looks like it has more to do with wrangling over the budget process and infrastructure bills.
Let me get our committee involved in the conversation. I know they'd like to begin.